Hi everyone, welcome back to Corporate Decoder, the place where we dissect corporate filings so you don't have to. Today we're diving into the annual report of Jet.AI, and folks, it's a bumpy ride. Think of it as turbulence on a budget airline. You might get where you're going, but you'll feel every bump along the way. Buckle up. We are looking at their annual report filed with the Securities and Exchange Commission. This is like the company's yearly health check, revealing everything from their financial standing to potential dangers ahead. Here's something that immediately jumps out. The aggregate market value of the voting and non-voting common equity held by non-affiliates was only $1.8 million. That's a tiny public float, meaning there aren't many shares readily available to trade, which can make the stock price super volatile. This report covers the financial year that ended December 31, 2024, so we are getting a look at their performance throughout the whole year. As with any business, Jet.AI faces a ton of risks, so we will start by checking some out. The company is an early stage company with a limited operating history and may not have enough capital to sustain the business. And there's this juicy bit, the proposed transactions with Fly Exclusive may not be completed, and the AI sector in which Jet.AI expects to primarily focus after the transactions is subject to significant risks. This hints at some major strategic shifts and potential pitfalls ahead. What are those? We'll get to that later. Jet.AI, in simple terms, wants to use artificial intelligence to revolutionize private jet travel. They've got apps, they manage aircraft, and they're trying to make it easier for people to book private jets. We see here they enacted a reverse stock split of its issued and outstanding shares of common stock at a ratio of 225 old shares and combined them into one new share. Here's the big news. They entered into an agreement to potentially merge with Fly Exclusive Inc. What's Fly Exclusive? That doesn't matter so much. What's important is this. Jet.AI will transfer its fractional and jet card business, and after the transactions, Jet.AI will continue to operate and retain its software and intellectual property assets, but will cease to hold its aircraft, fractional, jet card, and management assets, and expects to pursue additional business opportunities in the artificial intelligence AI sector, utilizing its remaining assets to enhance those business operations and model. They're basically pivoting almost entirely to the AI side of things. They launched something called Reroute AI to help private jet operators fill empty flight legs. When prompted with basic travel itinerary information such as city, pair, and date of travel, Reroute AI searches its database of empty constraints it has been given. Jet.AI generates revenue from Reroute AI when an operator wishes to book an itinerary proposed by the software that involves the use of aircraft outside that operator's fleet. And there's DynoFlight is a software API that enables aircraft operators to track and estimate emissions and then purchase carbon offset credits. We are told that it enables aircraft operators to track and estimate emissions and then purchase carbon offset credits. The goal is to introduce small to medium-sized operators a way to begin tracking and offsetting their carbon credits. The company's aircraft fleet consists of 5 aircraft, 3 HondaJet Elites, 1 Citation CJ4 Gen 2 aircraft, and 1 King Air 350i aircraft. Now, let's get into the numbers. Remember how I said it was a bumpy ride? Let's have a look at how bumpy it is. First, the top line, revenues for 2024 totaled $14 million, a $1.8 million, a $1.8 million increase from revenues of 12.2 during the comparable period for 2023. That's a decent jump, but not huge. Looking deeper, we see a rise of 6.3% in software revenue. This means that their core business is not growing as much as you'd hope. Now, for the scary part, cost of revenues, this is what it cost them to actually provide their services. It jumped from $12.4 million to almost $15 million. That's not good, because if it cost more to make money, that's bad. The resulting gross loss totaled $965,000 for 2024. They are losing money in what is supposed to be their main way of making revenue. To the increased gross loss in these operations was a result of increased maintenance costs, together with lower utilization on our HondaJet Elites. General and administrative, think of it as the cost of keeping the lights on and paying the executives, comes in at almost 11 million. Their net loss to common stockholders is $13,382,993. Again, not good when what you want is profit. But hey, they have cash. They started and ended the year with roughly $6 million. So despite them losing money, they were able to replenish their funds. We will look into it after. This is how the company said they were able to generate about 12 million by issuing even more shares, diluting the ownership of people who already own them, but you can't have it all. And for a company in this situation, you take it when you can. And Series B preferred stock, a large amount that came from the sale of Series B stocks. Here's a fun potential problem. If we fail to comply with the continued listing requirements of NASDAQ, we would face possible delisting, which would result in a limited public market for our shares, limit our ability to access existing liquidity facilities, and make obtaining future financing more difficult for us. If they fail compliance and are delisted, they might be in big trouble and might be hard to recover from that. They are taking advantage of something called the Jobs Act. The Jobs Act permits emerging growth companies like us to take advantage of certain exemptions from various reporting requirements. Another fun fact that affects the company as a whole, they did a reverse stock split, which affected a lot of their previous values, as all values have to be re-adjusted for it. Now, cybersecurity, it's a big deal for everyone, especially companies dealing with sensitive client data. Here, the filing mentions we have developed and implemented cybersecurity risk management processes intended to protect the confidentiality, integrity, and availability of our critical systems and information. However, it seems that they haven't faced any major incidents, at least not yet. And someone has to be on top of it, so it's good that their board of directors oversees our risk management, including our information technology and cybersecurity policies, procedures, and risk assessments. They are taking it seriously, which is good. Now let's see about legal issues. The company is not party to any material legal proceedings. That's always a good thing. Let's peek at who's steering this ship. We see names like Michael D. Winston, the executive chairman and interim chief executive officer, and George Murnane, the interim chief financial officer. Scroll compensation, S committee interlocks, and insider participation. Scub looking at how the executives get paid. It seems the compensation committee is independent. This is important to see who are doing the evaluation and how the money gets distributed. There's a lot more detail, but these are the highlights I found, so let's recap all of this. It has been a bumpy flight indeed, and here is my opinion about what is happening in this specific company. Is Jet.AI going to revolutionize private aviation with AI? Possibly, but the data is not good. The pivot to AI is interesting. However, the finances don't seem to be improving. The AI sector in which Jet.AI expects to primarily focus after the transactions is subject to significant risks, including rapid growth and volatility, capital requirements, dependence on rapidly changing underlying technologies, market and political risks and uncertainties, and extreme competition. Their continued losses are concerning, and while new sales do help, it's not enough to offset the cost. This is all further aggravated that if they fail to comply with the continued listing requirements of NASDAQ, they would face possible delisting, which would limit the liquidity on their stock. Thanks for watching, and as always, do your own research and don't take my word for it. If you found this helpful, like, comment, and subscribe for more corporate decoding. See you next time.